The only sore spot on the bank Nifty as the company's Q3 earnings failed to enthuse investors. And on the watch list today, two-wheeler majors Bajaj Auto and TVS Motor are all set to report their Q3, double-digit rise in profits expected. And it's an NDTV Profit exclusive. Sources tell your channel that the granular details of FPI beneficial ownership are likely to be lesser than SEBI estimated, impact to be limited. Hello and welcome. This is the F&O Show. I am Agam Vakil, and in this show we take you through all that is happening in the futures and options space in Indian equity markets. For now, there is a bout of short covering, it seems, and while we opened in the green, in the red, and we have now seen markets recover and are now comfortably in above the green. Now, as far as your benchmarks go, we are looking at an advance and to the tune of 0.7% as far as the Nifty is concerned, and the Sensex as well. It's not very different, the picture there. But the bank Nifty is where we are seeing some amount of strength return, and it is now up 0.9%. So it is moving back above the mark of, I would say, in trying to reach towards 44,500. That perhaps could be, a place from which you could start seeing genuine bout of short covering. That said, as far as the markets go, at least in terms of constituents, let's take a look at that. Of course, the broader markets are moving largely in tandem with the benchmark, slightly higher up. In terms of constituents, HDFC Bank is finally showing some strength now, and it is advancing along with Infi, L&T and SBI. SBI is also seeing about a short covering, and what's weighing on the indices, of course, is Axis Bank and Asian Paints, along with something like TCS, among many others. Hero MotoCorp is the other one, which is also in focus. But what about the broader markets? Again, when it comes to the broader markets, we are not seeing as much traction as much as what we're seeing as far as your recovery goes. Of course, your mid-cap index is up and about and in the green for now. But we are seeing good gains in returns in REC, PFC and IRFC. So these are the three government entities which are looking at the strength return. And that's as far as how markets are panning out. We take a small detour and we address Havells India, which came out with its December quarter earnings, and the company reported a marginal uptick in profit. And we spoke to the management of the company on the quarter gone by. Here's a slice of that conversation.
We have 75% of the business coming from B2C, and B2B business about 25%. We do see a very strong pull from the B2B segment. Even on the B2C side, actually, if you break it down, we are seeing some muted growth coming in from the B and C class towns in the rural areas. But overall, we are quite satisfied because, if you see products which are like electrical consumer durables, if we take out the fans high base last year because of the energy rating change, we have seen good traction in appliances. We have seen good traction in water heaters. Even lighting, consumer lighting has also grown significantly on volume basis. It has degrown because of the value erosion for LED raw material. But otherwise, volume growth is strong. Even in the switchgear segment, if you break it down, the residential and consumer demand has actually been strong because residential sector has been doing well. We've seen some weakness in one particular area. Overall, because for summer products, this is not really a consumption quarter, and it is more of a channel shelf filling quarter. We are expecting in the fourth quarter, we'll see revival in the demand because of many factors. And this is the reason, because of these factors, that we see a little bit of a muted quarter in the third quarter. On the margins front, actually, if you break it down, we are seeing improvement in all segments, including Lloyd, switchgear, lighting, ECD. We're seeing margin improvement in all segments. It's just that the third quarter we use, it as a long-term investment base for advertising promotion, where we actually increase the spends quite high because of the World Cup, the festive season, the incoming summer season. But we do believe that, once this is normalized, the overall EBITDA margins will also start improving.
All right. Let me just go through that one by one. You talked about demand in residential being robust except for one segment. Can you just elaborate on that, on the kind of demand we're getting and in what segment of products? Are you seeing higher end premium products in greater demand and higher margin products? Just give us a clearer picture on what's happening on the residential end.
On the residential side, we actually see improvement in the premium segment, and that is also because of the fact that we are seeing more robust growth coming from A-class and urban towns, and a little bit of muted growth from the B and C and rural areas, where the not the very premium products will be going. Also, within the switchgear business, we are seeing high growth in the B2B segment, and the B2C segment, even in the urban areas, we are seeing decent growth. Where we're seeing some slackness in demand is where we supply to the telecom sector, where the capex cycle has been a bit low in the last 1 year. But otherwise, generally speaking, we are seeing a recovery in the premium products. And once the B and C class towns and the rural areas demand starts picking up, we'll see overall growth in those segments.
Right, that's the management of Havells telling us about the quarter gone by and what we can expect going forward. But we shift focus back to the futures and options space. We do have guests with us, but before that, let me very quickly address what's happening in F&O. So I'm going to start off with your future snapshot. Let's pull up the Nifty futures. And at the moment, we're looking at a 2.5% increase in open interest. And this is potentially longs at the moment. But remember that this is the January futures, where, of course, a lot of the rollovers will now start playing out over the course of today and tomorrow. And then, of course, we move into a new series. That said, as far as the Bank Nifty futures go, let's pull that one as well and take a look at how things are faring there. So a lot of unwinding coming through with open interest declining by around well over 12%, even as we see the Bank Nifty advance by 0.9%. Now, it does seem like it is about a short covering, but on the other hand, February is also looking at a build up there. So we are starting to see rollovers, pick up, at least as far as the Bank Nifty is concerned. Remember, until yesterday, we were also looking at the Bank Nifty trade at a significant discount. This is the open interest distribution in terms of the Nifty. Now, on the higher end, of course, we continue to see 21,700 and thereabouts, seeing the most amount of call OI concentration. On the lower end, 21,000 is the one. So it's a 700-point range. And let's not forget that the VIX has certainly inched up even in today's day of trade, even though it could potentially be a result of and buying interest as far as calls are concerned. So keep an eye on that one. And let's also pull up, yes, that's the VIX. In fact, it has come off now after a surge in intraday. So through the course, earlier in the morning, we had seen it move above the mark of 15. And now it has come off. This, of course, isn't necessarily bad news, because this may also indicate that we are in fact now heading into a bout of consolidation after the substantial volatility that we have seen in fact over the previous few days. This is a change in open interest on the Nifty, and as one might expect, not too much happening here. Let's not forget that we have seen a sharp covering since morning trade, but we are still seeing a lot of call writing around the high level, so keep an eye on that one. Well, on that note, let's get in experts for today. At the moment, we have with us Dhwani Patel. She's the founder of Finversify, who's joining us on the show. Well, Dhwani, good morning. Thanks for joining in. Let's start with your view on the benchmarks. How are you playing this bout of short covering? Is this bout of short covering something that can in fact sustain?
Good morning, Agam. Definitely on the index, we are seeing some short covering coming in today. The point to be noted over here is both the indices, Nifty and Bank Nifty, have taken up support of two exponential moving averages and shown a bounce from the same level. On Nifty, we are seeing 50-period exponential moving average on a daily chart working out well, and from the current levels, we are seeing the bounce coming in. But over here, I also see that a 20-period exponential moving average will work out as a resistance over there. So 21,550 is the level I'm looking out for now. Once taken that out decisively, I would go longs on the index from then onwards. But till we are not moving above 21,500, I do not see much of a strength coming in on the index over here, because also on an intraday 30-minute chart, technically what we are seeing is definitely the bounce is working out well, but then again the moving averages on the higher side are acting as resistance. We are still trading below the moving averages on an intraday 30-minute chart on the Nifty right now. And on Bank Nifty, also what we are seeing is a similar kind of a setup. Definitely Bank Nifty has taken more beating is in terms of the cuts that we have seen in the past few days, because Bank Nifty has taken up a support at a 200-period exponential moving average, which is below the 50-period. And we are seeing a bounce coming in from those levels on the Bank Nifty over here. Bank Nifty, again, right now that we're trading at the current level, is taking a resistance again at the short-term moving averages on a intraday 30-minute time frame. And from there, we are seeing a constant downtick coming in on lower time frames over here. So I'll be cautious on Bank Nifty as well. On Bank Nifty, the level that I'll be looking out on the higher side to be taken up decisively is going to be 45,780. Once 45,780 has been taken out decisively, one can go long on the index, on both the index. So I'm holding a cautious view for the longs from the current level. And again, sector-specific rotation is being seen in different indices over here. Especially pharma is leading the whole pack. We are seeing Nifty Pharma Index over here maintaining its primary trajectory of a higher high, higher low time frame. And in today's session also, we are seeing that previous day lows were not being taken out, and we are constantly trading on the upside over here.
Right. Of course, while the trend in the morning may have been on the upside since then, we are now starting to see a little bit of moderation as far as benchmarks go on an intraday basis. And, as Dhwani has mentioned, we still want to see higher levels both on the Nifty as well as the Bank Nifty. Before that, we really do not want to go considerably long, and notwithstanding the strength that we've seen since morning, we still need a lot more in terms of data points before we can in fact say that the current course of correction is behind us. And that will be crucial because, while we see bouts of short covering here and there, what is also important is that short covering can in fact end, and then we can see about a consolidation. That's as far as your benchmarks are concerned. On that note, we take a quick break, but on the other side, we talk about stocks and a lot more. Stay tuned. Welcome back. We are in the F&O show, and at the moment we are looking at a slight bit of moderation when it comes to the benchmarks, and both the Nifty and the Bank Nifty are off days highs. Nothing to worry about as such because we are still in the green, but the question is that what's in store ahead given the kind of volatility that we have been used to of late. We actually have with us Aditya Agarwala, Head of Research and Investments at Invest for Edu, also joining us in the show. Aditya, good morning. Thanks for joining in. We were talking to Dhwani about the benchmarks earlier, and she was of the opinion, of course, that we still need to see both the benchmarks, the Nifty as well as the Bank Nifty, move to considerably higher levels from here before we can, in fact, initiate longs. Would you concur? How are you playing these benchmarks?
Morning, Agam. Thanks for having the show. Oh, absolutely. I believe something interesting I will point out here is yesterday was the first day when index actually formed a lower low and a lower high. If you talk about technicals, this is an indication that the trend has reversed, at least an intermediate trend has reversed, and markets are looking at lower levels. Given the fact that we are having a pullback today, it could be just a temporary pullback or a dead cat bounce, as we call Agam, because markets were a little oversold. On the Nifty, I would watch out for 21,400 on the spot. That happens to be an immediate hurdle. Until and unless that is taken out decisively, I don't think there'll be any meaningful short covering rally that we will see. Same holds true for Bank Nifty as well. I believe there is a lot of short positions which were built up in Bank Nifty, and it was oversold, Agam. So a bit of a pullback was on cards. We could see further pullback at least to levels of 45, 500, about 45, 450 levels. But my sense is, again, we haven't formed a bottom yet, and I believe markets will be in for a choppy ride, at least for next couple of weeks, and we could see markets all over the place, both the Nifty and the Bank Nifty, and we could see a breach of 21,000 as well on the Nifty, which is where the maximum open interest is at the moment. So if 21,000 is broken, then that could lead to a further slide on the markets to 2,800.
Right, absolutely. 21,000 is a crucial level, and I'm sure a lot of participants are betting on the Nifty not hitting 21,000, at least in the near term. That said, we'll keep an eye on that one. But let's talk about stocks then, and let's start by taking a look at all the stocks, all the stock futures, in fact, which are looking at seeing an increase in open interest today. So we have Dalmia Bharat, Persistent Systems, Colgate, and HCL Technologies. All of them who are seeing an open interest increase of well over 10% in their respective futures, and this is January futures, mind you. And we're seeing a slight bit of an uptick as far as your underlying is concerned. That means that there are still longs playing there. Canara Bank, on the other hand, is looking at some amount of shorts, but the underlying is really not declined as much, less than 1%. In terms of open interest losers, and of course, this will be a longer list because remember that we are moving into the rollover period, which means that unwinding will be substantially higher, at least as far as your January futures go naturally. But Metropolis, J&K Cement, Birlasoft, Atul and Chamel Fertilizers make that list. On that note, let's take a look at what our experts are recommending. So, Dhwani, I come to you. What trading ideas do you have for us?
As I started the show with saying that pharma is leading the pack today. So from pharma itself, I'm picking first on Dr. Reddy's. Dr. Reddy's looks promising over here. The overall move on today's session is suggesting a bullish side continuation over here. February series is what I'm recommending over here. One can go long into February series from the current levels, which we are currently trading at about 5,900 levels. And from there, we are seeing an up move coming in over here. First is 6,000, then 6,040 is to be taken out. Once 6,040 is taken out, you'll see further momentum coming in. The February series over here can be played out with the strategy of trailing stop loss as well. For the current buy, I'm recommending a stop loss of 5,750. The next stock that I have is also again from a defensive sector because I do not hold too much of a long side view on the index over here. So Godrej Consumer Products is what I'm picking over here. The next one for February series, you can grow longer over here above 1155, and the target over here is of 1200. Then 1220 is the next target on this particular counter for the Feb series, and the stop loss that you need to maintain is 1130.
Okay, Aditya, stocks on your radar this afternoon?
So Agam, I've got a similar recommendation on Dr. Reddy's. It's a fabulous looking chart structure and looks like there's a long build-up as well there. I'm looking at a target of 6,200 on Dr. Reddy's, and it's breaking out from a long consolidation pattern with a stop loss at 5,700. Looks like an excellent trade to take. Second is from a Siemens pack. I believe there are pockets which are outperforming within the Siemens pack. So JK Cement is looking very interesting on the charts. One can actually look at going fresh long at current levels. Look for a target of 4,200 to about 4,300 on the upside, with a stop loss at 4,000 on the downside. Looks like a decent trade to take, Agam.
Okay, fair enough. Well, we also want to address a handful of names in this case. We tend to take up stocks which are generally or have become hard to trade, especially for viewers who may have, in fact, dabbled in some of these stocks. So I want to talk about Z Entertainment specifically in this case. Dhwani, I'll take this one up with you. How would you address the stock? What would you do? One, from a point of view of fresh entry, and second, from a point of view that if you had, in fact, gotten a chance to short, would you, in fact, go ahead and book?
Agam, I would be lucky enough if I would have got a chance to short on this particular counter, because if I'm holding shorts on it, I would definitely like to roll over them and carry forward. As far as longs are concerned, I do not see the stock making any bottom formations over here, even on a lower or a higher time frame. So for long, this is not the right time. Wait for it. We don't know how this dip is going to work out, but for shorts, definitely you must hold on to it. It's like a falling knife. We don't know how deep it's going to cut over here. The next target, technically over here also, I would refrain from commenting on that thing. It's just a trailing stop loss that you need to maintain over here. The next trailing stop loss over here for Feb series that you need to maintain is on the higher side over here of 171. Till the time in Feb series we are holding above 171 level, going above 171 levels. It's then you cut on your shorts over here. Till then you just hold on to it.
Right. Aditya, the other hard stock that you want to talk about naturally, and this may be easier to guess than trade, will be HDFC Bank. It's currently made a low of around, so 1,380 odd levels this morning. And from there, we've seen a little bit of recovery coming through. What's your take on this one? How would you address this?
Agam, just a disclaimer here that I do hold the stock in my portfolio and has been recommended to clients at current levels. I believe this is a good stock to actually start nibbling into it. I see a short covering rally, follow through rally coming into the stock. Today's low is very important. That happens to be a crucial trend line support plus a Fibonacci retracement level as well. Just the immediate resistance is at 1450, 1455. If that is taken out decisively and stock manages to trade above that, my sense is stock will see a decent kind of short covering rally at least till levels of 1520. So if you're holding on to short positions, I would recommend cut down on your shorts. If you're sitting on profits, not a bad idea to start booking profits on your shorts. If you're looking to go long, I think this is the right time to start looking at HDFC Bank from a long trade. Maybe next month's expiry, you can look to add on to your long positions with a stop loss at 1360, 1375, and at least look for a target of 1530 to about 1550 on the upside.
Okay, we keep an eye on those levels on Z Entertainment as well as HDFC Bank, but we've run out of time on the show, so I'm going to take a moment to thank both our experts, Aditya and Dhwani, for joining us and taking us through their views on the markets. And before we call it a wrap on the show, Zerodha's MP's first growth liquid ETF, the Zerodha Nifty 1D rate liquid ETF debuts today. My colleague Saloni caught up with the Zerodha Fund House CEO Vishal Jain on the sidelines of the event. Listen in.
In the market as of today, there are around 7 liquid ETFs, and together they have an AUM of about 15,000 crores or so. All these ETFs pay dividend on a daily basis, and at times it can be difficult for investors to track the returns in these ETFs. What we have done is we've innovated on this product, on this structure, and the ETF that we've launched is the Zerodha Nifty 1-Day Rate Growth ETF. Growth liquid ETF. The difference between this ETF and other ETFs is that here, because it's a growth ETF, the NAV will reflect the returns of the product on a day-to-day basis, and therefore it becomes much more easier for investors to track returns on the product.
Right. You've pretty new in the passive mutual fund business. You've already launched this your third fund, if I'm not wrong. So can you help us understand how's the business terms been, kind of clients that you're seeing, kind of AUMs also, especially after launching the third fund?
Right, so we've had an overwhelming response till now. We're a passive-only fund house, focusing only on retail investors. And as you said, it's our third product. We've got an overwhelming response. I mean, we had an NFO of the first two products, and we raised about 104 crores in that NFO, and our AUM has already crossed about 250 crores in both these products, in a short span of about 3 months or so. So we're very excited about the journey. This is again, one of the products that we feel we've created especially for retail investors, and we think that, the journey has just begun for us, and you'll see a lot more coming from us in the coming few weeks.